So in our FASB update today, we're going to touch on just two new standards that have come out so far this year, go through the standards that are coming down the pike, which for public companies will include DISE, disaggregation of income statement expenses. It's a major new disclosure standard that we'll talk about how the adoption of that standard is going. Then we'll talk about the impact of the 2025 agenda consultation that FASB performed. It is an occasional process, the first one since 2021, that FASB goes through in order to populate its technical and research agendas. And then we will talk about the agenda itself, kind of where it stands, and topics are still being added to it from that consultation. So the first of the two accounting standards that came out this year is SU 2026-01. It is pretty narrow in its scope and its applicability. It deals specifically with paid-in-kind dividends on preferred stock classified in equity, and that includes preferred stock classified in the mezzanine. So the amendments in this update require that paid-in-kind dividends on equity classified preferred stock be initially measured on the basis of the dividend rate that is stated in the preferred stock agreement. So there was some diversity in practice before this update. Some preparers measured paid-in-kind dividends at their fair value, so the fair value of the additional preferred stock equity that was issued to preferred shareholders. So this update will be effective in 2027 for calendar year companies, and early adoption is permitted. So the second of the two updates to come out so far this year was more impactful, and it deals with the recognition and measurement of environmental credit assets and liabilities. So, and it has definitions of those terms and sets the criteria for recognizing the assets and liabilities related to environmental credits. So under this standard, environmental credit assets will be recognized if credits are being held for transfer, could be for sale or for exchange. So they're being held for transfer or to satisfy legal or contractual obligations. So if credits are being purchased by an entity voluntarily, perhaps it made commitments to the broader population for marketing purposes or public relations purposes. Those are not legal obligations that they have to fulfill. So in those cases, the environmental credits that are being purchased will be expensed. Environmental credit assets will be measured at cost, generally, and subject to impairment afterwards. Environmental credit liabilities will only be recognized kind of similarly if there's a legal or contractual obligation that may be settled with environmental credits. They will be recognized in terms of timing of recognition of the obligations. They should be recognized when emissions occur and measured at the carrying amount of the environmental credits. So if a company is holding credit assets and it has obligations to be settled in environmental credits, those should be recognized at the same amount. However, if there's obligations in excess of the credit assets that are being held, that excess should be measured at the fair value of the additional credits that are necessary to satisfy the obligation. SU 2026-02 will be effective in 2028 for public companies and 2029 for private companies. Early adoption is permitted. So as I said, only two standards, neither, I would say, extremely impactful this year. But if last year is any indication, and FASB's agenda that we'll touch on later is any indication, the rest of the year is looking to be busier. Next, we'll cover the standards that will be effective in this year and beyond for public companies. So year-end public companies have already had to deal with the first two of those standards, SU 2024-04 and 2025-05. So these are the standards that have been issued in prior years that are not yet effective, that you should keep in mind. We'll talk more about DISE, which is the disaggregation of income statement expenses, ASU 2024-03, that will be effective for year-end 2027 and subsequent interim reporting. We'll talk about that one some length, but there are other standards that I would highlight. One is ASU 2025-05. It is already effective for calendar year companies. For off-calendar year, it will become effective in the year that's about to start. And it simplifies the allowance guidance, bad debt expense guidance for trade accounts receivable, allowing companies to consider subsequent collections, and also allowing companies to assume that the economic environment will stay the same for that short-term account receivable collection window. The other major standard that I would highlight on here is ASU 2025-06. Now that one won't be effective until 2028, but it will significantly change how companies capitalize and whether they capitalize internal use software. So it can be things like the product that's offered to the customers for access by SaaS companies, or it can be some internally developed software for internal needs, or it can be implementations of things like ERP systems, implementations of third-party systems. In general, especially for the first two types of internal use software, so software developed by SaaS companies for access to their customers and other internally developed software, we're expecting that the amount capitalized will decrease significantly. There will be, instead of having defined stages for development in the legacy GAAP, the new standard has a requirement that the development be probable, that there are no significant uncertainties in that development, which is kind of similar to what is currently GAAP for software for external sale. So we expect that having this requirement will decrease the amount, will set back the time at which costs will be able to be capitalized for some internally used software. So as I mentioned, we want to touch on DISE. Now, DISE came out in 2024. It was extensively covered in our prior updates, and there's a lot of content out there about it. But the short of it is that public companies will have to disclose the detail of income statement expenses that contain at least one of the following: employee compensation, purchases of inventory, or depreciation, amortization, and depletion. So when income statement accounts are disaggregated, those categories will have to be presented separately in the disaggregation, quantified, and amounts that don't fall into those categories will be grouped at other, as an other line for each income statement expense line item that's being disaggregated, and that other category will be described qualitatively. So the most recent, and again, this is a standard only for public companies, but it is an impactful one. And the most recent development here, there was a FASB roundtable last month that, in addition to FASB staff, was attended by representatives from accounting firms, analyst agencies, and 10 preparers. Now, those preparers were generally or mostly large companies across multiple industries. Think of Boeing, Pfizer, Procter Gamble, Wells Fargo. And those companies are in different stages of DISE implementation, but it's notable that none of them have adopted it yet. And some have reported already putting in significant resources. Now these are well-resourced large firms putting significant resources into DISE implementation. The only exception, so a company that has adopted and whose DISE disclosure you can see, was Coinbase. So you can look at their last 10K and see their DISE footnote. In terms of the challenges that companies face, so although DISE is a disclosure-only standard, the disclosure requirements are prescriptive. Companies have to have a breakout of operating expense line items that is auditable. So it has to be auditable amounts of employee compensation, purchase of inventory, depreciation, amortization, and we'll talk on the next slide about some of the challenges that on that panel that I mentioned that preparers brought up. But it is important to keep in mind that those amounts are required and have to be auditable. It is part of the audit of financial statements. So in terms of the adoption challenges, so the preparers on the FASB panel echoed several areas of concern, I would say, with the new standard. Organizations with multiple business units may allocate costs from one entity to another, and the characteristics of those costs, so for example, how much is employee compensation versus depreciation versus other costs, are often lost in such allocations. So one example of that could be a vertically integrated manufacturing entity that has a production business unit, a cost center, and a distribution entity. And if the production entity purchases inventory, incurs manufacturing labor costs, but then it often charges single sale price for that intercompany transaction to the distribution entity. And in that process, the components of the cost may get lost. So if the distribution entity is also the reporting entity, they might not have the information about how much of the cost was employee compensation, how much was purchase of inventory, and so forth. So companies may have to estimate or add new business unit level reporting or reporting systems to sit on top of the existing reporting structures in order to report the required level of detail. Some preparers alerted FASB that they expect some of their income statement line items, significant ones, to mostly consist of other. One example was Exxon, which expressed that the energy cost of refining is a large cost element, and that doesn't really fall into any of the specifically enumerated categories. It's not employee compensation or purchase of inventory or depreciation amortization. So it will be other. So it'll be a large other component within some of the cost items. And finally, some preparers struggled with the definition of purchase of inventory. So it's defined as amounts that are capitalized as cost of inventory that are paid to third parties. So, for example, it's unclear whether utilities costs that are capitalized in the manufacturing process are those inventory purchases, since they're paid to third parties. Now, one thing to note is that the analyst agency participants, so essentially representing users of the financial statements, continue to express strong support for these disclosures and the need to get that information. So we don't expect the standard to go away as a result of this panel, but there were adoption challenges brought up, and even the potential deferral was mentioned, even though that kind of caused some consternation from some FASB members who don't seem to want to defer that further, so as to stop action on the adoption.